Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. This year has been a stark reminder that the stock market does not move up in a straight line. The long-term average annual return for the S&P 500 is nearly 9%. It doesn't look like we'll hit that this year. So far, the losses have been significant. The only sector of the economy with gains for the first 6 months of the year is the energy sector, and that's partly because the sector was the worst performer through the early part of the pandemic. The losses in some of the best performing sectors the last few years are tremendous. Technology has lost 28%. Consumer discretionary, which includes Amazon, is down 33%. And the communications sector, which includes Facebook parent Meta Platforms, has declined 31% in the first half of the year. Even diversification in international equities or fixed income bonds has been a losing proposition this year. European stocks are down 27%. Emerging markets are down 19%. U.S. bonds, well, they've lost 10% through June, while international bonds have declined 14%. And if you're an investor in cryptocurrencies, well, you've done even worse. We're now beginning to see weakening in the real estate market as well. Mortgage rates have doubled from about 2.5% to more than 5.5%, raising interest costs for new loans substantially. With prices still hovering near all-time highs, it's only been a lack of inventory that's keeping housing costs up. To make all this feel even worse, inflation has hit essentials such as fuel, food, and housing the hardest. Higher prices and higher interest rates are making essentials more expensive, leaving fewer dollars to spend on other things, which translates into weaker retail sales, lower corporate earnings, and directly affects stock prices. So it's little wonder that the consumer confidence is near record lows. So while there is plenty of reason to be concerned, there are some encouraging signs. First of all, stocks are now cheaper than they were. A lot of expected bad news is already reflected in the price of stocks. To go lower, the expected bad news, well, it has to get a whole lot worse. But we do see slight improvements. Energy prices are off their June highs. So are average rents in the largest metropolitan areas. Employment is robust, and while hiring has slowed, for the most part, people that want jobs have jobs. Inflation is rapidly eating into the purchasing power of household income. But for the moment, the consumer, which is the principal driver of our economy, is in decent shape. We don't expect inflation to get materially worse in the second half of this year. Less certain is how much the economy will slow through the process of raising interest rates. So we do need inflation to stabilize quickly before the Federal Reserve has to raise interest rates so high that something more than a slight recession is inevitable. Here's a chart of inflation and 10-year Treasury yields since 1980. The problem is the most effective tool to rein in inflation is to raise interest rates. It's counterintuitive, but higher prices are the best cure for higher prices. If demand falls enough, supply increases and prices will stabilize. The market has sold off in anticipation of these problems. We're now at an inflection point. If growth merely slows from here, prices are plenty low enough today that we can move higher through the end of the year. If growth must slow considerably more, a real recession is necessary to eliminate inflation, well, then stocks will need to go lower before we can move forward. So there's tremendous uncertainty in the outlook. That's the reason for the significant swings in the market day to day. With so little certainty, it's easy to latch on to each new data point and predict the bottom on Monday or forecast a continued drop on Tuesday. The rest of this month, companies will be releasing their results for the second quarter. Even more important, they will also discuss the outlook for their individual businesses for the rest of the year. Wall Street analysts have been slow to revise corporate earnings estimates for 2022 and 2023, but we expect downward revisions as companies report second quarter results in the coming weeks. To debate whether the U.S. economy is sliding into a recession or not this year or even next is to miss the point. The fact of the matter is that the euphoria exiting the pandemic is over. Economic stimulus has been spent and growth has slowed. The party didn't last very long, but the hangover is now acute. We think the damage is largely done, however. We have reduced exposure to equities significantly in client accounts. Like the rest of the market, we remain uncertain, but we're cautiously optimistic that we'll be able to reinvest cash as inflation moderates and the prospects for growth next year increase. As unnerving as this year's losses are, equities will continue their long-term positive performance trajectory. Bear markets and recessions have occurred about 11 times since the 1960s. Despite these periods, the stock market remains the most rewarding long-term asset class for investment. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list so you receive our reports in your inbox. Thank you very much for watching.